transaction. This is everything you're going to need for to pass your exam, your real estate exam. And let's get into it. So a successful transaction, to be able to close, three things have to happen. Three things have to happen. One is the seller must provide good marketable title. The seller's property must appraise if there's an appraisal contingency or financing involved. And the buyer must be able to pay for the property. And if there is financing involved, there needs to be the lender needs to give a formal loan commitment. So typically the agreements are contingent upon the lender giving a formal loan commitment that the buyer is ready to go and we're ready to close the transaction. So a loan is an investment by the lender. So the lender lends them money and then gets a yield on their investment. The yield is the return, and the risk is the likelihood that the investment will lose money. So all investments don't make money. So the yield would be the interest rate or the profit that the lender is making on the loan. Okay, so if a lender's charge of 4%, his yield on that would be 4%. It's the return. The risk would be how much likelihood will that person who took the loan out make their payments. The higher the risk, the higher the yield. The lower the risk, the lower the yield. And it's just the same. So if you're a high risk buyer, you still may be able to get a loan, but you may be paying a higher interest rate. Factors that determine the interest rate is also the type of mortgage. Conventional, FHA, USDA, VA. Typically, there's more risk with an FHA, VA, or USDA. And the reason there's more risk is typically there's less money put down. So the lender has more of a liability if for some reason there would be a foreclosure. With conventional financing, there's a little bit less risk because what are the terms for how much down payment do you typically need for conventional financing? 5 to 20% down. So if a lender feels, well, if there's 20% down, there's less risk, right? If there's less risk, then they get less yield. The loan amount. Jumbo loans carry greater risk on the secondary market. So the secondary market, well, jumbo loans carry more risk, period. The secondary market sets upper limits for loans it will buy. So the secondary market may say, we don't want to take any loans over $600,000. So for example, we sold $1 million listing in Ross Draver last year, and the buyer obtained financing. So he had to use a lender that was going to portfolio or keep the loan in-house, not sell it on a secondary market, because the secondary market's saying, we want to limit the maximum mortgage amount in that pool of loans that they're going to be selling on a secondary market. And also the lender's cost of money. And this is big right now because all the talk is on TV is the Federal Reserve is going to increase interest rates. So the lender's cost of money. And it's funny, I talked to a lender the other day and we were talking about the Federal Reserve, and he said, all the money's owned by the government as far as the bank's concerned. They borrow money off the government to lend. And the lenders, the Federal Reserve indirectly regulates the flow of money as by increasing the interest rates that banks borrow off each other or the banks borrow off of the Federal Reserve. And then the Federal Reserve also could control the cost of money by setting the amount the bank has to keep on the sidelines for reserves. So if the Federal Reserve say, okay, any federal insured lenders have to keep 25% in reserves, then that means they only can lend out 75% of the money they have. If they say, okay, you only need 20% reserves, then they have more money to lend. And then once they lend that money out, they can make a yield on it and make money on it. And it sets the discount rate. They call that the discount rate, and that's the rate bank charge each other. Then also, so there's a lot of different things, man. When I was a loan originator, hell, there's a lot of different ththings you have to look at. Then there's the term of the loan. If it's a 30-year loan, you're going to get a higher interest rate than a 10-year loan, because the bank feels there's more opportunity for risk on a 30-year loan than there is on a 10-year loan, because it's a longer time frame. Shit can happen. Excuse my language. So how does a lender determine the interest rate? They're going to look at all these factors. They're going to look at what type of mortgage it is. They're going to look at what's the cost for them to borrow money from the Fed or another lender. They're going to look at how much they have to keep in reserves in their bank. They're going to look at the term of loan, 10 to 30 years, and they're going to look at the type of financing. Does that just all make sense? Okay, good, good. And they're also going to look at the credit score. What is the credit score? So they look at all those things. There is a Fair and Accurate Credit Transaction Act. It's required by all three major credit bureaus, because there's three bureaus for credit checks. There's three different big companies that do the credit checking. And typically when you're getting a mortgage, they'll pull a credit report from all three of them. All three provide free credit reports to consumers every 12 months upon request. And there's a toll-free number that you can call. And there's a toll-free number that you can call to assist consumers in correcting credit report mistakes. So my brother-in-law called me last night from Florida and said he's trying to buy a house. And he said somebody in Texas used my information to get electric for their house. And then once they got the electric hooked up, they didn't pay the bill. And it dinged my credit report 50 points. So I told him, I said, reach out to the credit reporting agency and talk to them. They have programs set up that if this wasn't your bill, that will be removed from your credit report. So there is a way to clean your credit report up for mistakes like that, or if it was fraudulent. So, he said, can you find out who the owner, bless you, who the owner of the house was? So, I kind of went on, online and started playing with it. And I found out who the owner was on record. And then I found the owner's phone number. And I sent it to my brother-in-law last night. My brother-in-law is crazy enough. He'll drive to Texas from Florida and just beat that guy. Ain't he, Lex?
The only way he found that out was from running his credit report.
Yep.
Like he never got notified.
No. Now I subscribe through Equifax to a service that I pay for and they check my credit daily. And if I open up an account, I get an email alert. If I have a balance that goes up or down, I get an email alert. And I talked to my wife about that last night. I said, Nene, do you got anything like that? She said, no. Yeah. So there's different things out there. There's just so much fraud anymore. I don't want anybody. I worked real hard, man, because I had bad credit when I first started in the real estate business. But the credit reporting agencies will work with you to assist in correcting credit report mistakes. The loan application process. Buyers provide the lender with the personal information needed to get a loan. So they're going to want to see, bank statements. They're going to want to know who your employer is so they can contact your employer to make sure that you're working. There's just a whole bunch of paperwork that needs to be. They may want to see your tax returns. Then, once they take the loan application, that's the first step. So, Samantha, if you get this property, the first step will be you'll go apply for a loan, and that's the loan application process. You already did that. Okay, good girl. So then the next step will be the appraisal, the inspection period, and then once you get those knocked out of the way, then they'll underwrite the loan. And underwriting the loan is where the bank's underwriters, they have an underwriter, they'll look at everything. They'll look at the whole picture. And then they will give you a commitment, that's the loan commitment, in writing, stating that they're going to lend you the money. And then in most cases, you have to forward that commitment to the seller. I mean, most agreements have a time frame. What's up, Ray?
Hey, how you doing?
Good. We need to get Ray. Can you sign in, Ray, for us?
Sure.
You got it? In most cases, that loan commitment, the agreement states, has to be given to the seller, or the seller can call the agreement null and void if you don't within a certain time frame. So, for example, one of my agents, Lisa Reed, the only reason she lives in the house she lives in is because before she bought it, I had that house listed, and I had a buyer, and we had a contract. And in the contract, it said that the loan commitment had to be given to the seller within so many days of signing the agreement. And I didn't get that agreement over to the seller, that loan commitment, within a time frame in the agreement. And the seller called me up one day and said, hey, we're not going to sell. So, and they had a right to do that because I didn't get the loan commitment to them in accordance with the sales agreement. The Equal Credit Opportunity Act prohibits discrimination because of race, color, religion, national origin, sex, marital status, or age, providing that the applicant is of legal age. So as long as you're of legal age over 18, they can't discriminate. If you're 99 years old and you want to get a 30-year mortgage, they can't say no. Lenders and creditors must inform rejected credit applications in writing within 30 days and why the credit was denied or terminated. So I would know that for the test, that according to the Equal Credit Opportunity Act, we know that they can't discriminate because of any of the protected classes, but that if you're denied credit within 30 days, they have to give you notice and tell you why you were denied. And the law states borrowers are entitled to a copy of the appraisal if the buyer paid for it. So in your case, Samantha, are you just going to have to pay for an appraisal?
The banks that have their own appraiser, but we have to pay for it.
Okay, so if you have to pay for it, you have to write for that copy of that appraisal. That's what the law says. Okay. So let's talk a little bit about some financial legislation. Okay, financial legislation. There's the Truth in Lending Act, and it's a popular name for the Federal Consumer Credit Act. This act was implemented by what they call Regulation C. So you're going to want to know the Truth in Lending Act, and it can also be called the Federal Consumer Credit Act. And it requires lenders to disclose to borrowers the true cost of obtaining credit, so that the customer can compare interest rates with other lenders. So if you're getting a mortgage, they're going to be required to give you the true cost. Okay. Now, when I say the true cost, because if you're paying points up front, that's included in the cost of credit. If you're paying some other fees, that could be included in the cost of credit. And it applies to all loans $25,000 or less for private consumers, or any transaction secured by a residence. So that's tricky. Loans for $25,000 and less that are not secured by real estate, but if it's secured by real estate, it's required on them all. It does not apply to agricultural loans, business, or commercial loans over $25,000. So 25,000 is the number to know. If there's no collateral, 25 or under, if there's any real estate involved at all, they have to show them the true cost of credit. And on commercial or commercial loans over 25, they don't have to. Does not apply. Basically, all they want is the consumer to know the true cost of credit. Makes sense, right, Lauren? Okay. And it requires that the lender compute and disclose the annual percentage rate, the APR. And that's the true cost of financing with any other cost that would be included. And for the purpose of Regulation Z, and again, that Regulation Z, if we go back to it, the Truth in Lending Act is a popular name for the Federal Consumer Credit Act. This act was implemented by Regulation Z, so according to Regulation Z, a creditor is defined by any creditor that extends consumer credit more than 25 times a year, or somebody that gives credit more than 5 times a year in a transaction involving a dwelling as security, or credit subject to finance charges or payable in more than 4 installments. The 3-day rate of rescission. Have you all heard of this? 3-day rate of rescission. Anybody ever buy a car? Ray, you were a car salesman.
Yes, sir.
So you had 3 days. How many people signed up, signed everything, and then had 3 days to renege? They all had a right to do that, but how many actually renege?
Very few.
Very few.
You might have had in a year's time, I can recall maybe 2 or 3 people.
2 or 3 people, because they had a 3-day rate of rescission. And it does not apply to residential first mortgages or deed of trust loans. Oh, what's the difference between a residential first mortgage and a deed of trust?
What do you say?
Residential.
What's the difference between, because the 3-day rate of rescission, right, Alan, doesn't apply to residential first mortgages or a deed of trust. So what's the difference between a deed of trust and a residential first mortgage?
The title?
Is it deed of trust
Yeah,
rate?
the
Oh, you were on the right track. So isn't there lien theory states and title theory states? And then what's the third one? Intermediate theory, right? What's Pennsylvania?
Intermediate.
Intermediate. In a lien theory state, the lender puts a lien on the property, title stays with the borrower, okay? With a title theory state, the borrower gives the deed to the lender, right? And that would be called a deed of trust loan because they're given the deed. And then usually a third party, the trustee, holds that. Advertising that's strictly regulated by Reg Z. All media. General phrases like liberal terms available may be used. Any mention of interest rate, you have to give the annual percentage rate. And the total finance charge must be specified. So this chapter is a little bit more difficult. You came just the right time, Lise, because the financing chapter is kind of a tough chapter because the chapters we went over this morning, there was a lot of common sense stuff. This is a lot of Greek if you're not doing, not using it on a regular basis. So trigger terms. In the book, it states trigger terms. In any specific loan terms that are mentioned in the advertising, all terms must be included, such as the cash price, the down payment, the number and amount and dates, the payments for the payments, the annual percentage rate. These are all called trigger terms. So if you're at, let me try to put it in layman's terms, Christine. If I have an ad in the newspaper that says, buy this house, 0 down. Is zero down one of the trigger terms? Yes. Then I have to put what the cash price is. I have to put with the how many payments. I have to put the annual percentage rate. So I have to add all those other terms. If I say buy this house with, and I'll give you a 2% mortgage, I have to put the cash price, $100,000. Down payment, 20% down, whatever the down payment is, whatever the interest rate. So the trigger terms are, if any one of these terms are used, then you have to use them all so the consumer knows, because then you're not scamming somebody. Because if I say zero money down will get you this house in Ross Draver, I'd get 1 million phone calls. Yeah, it can be 0 down, but you can be paying 20% interest rate. So if you're going to say 0 down, they want to know the interest rate, the cash price, the term, and so forth. So we're on unit 19. Does anybody know what page we're on? Anybody got a page?
375.
375. So penalties under Reg Z for non-compliance. The fine of twice the amount of the finance charge with $100 minimum and $1,000 maximum. Court costs, attorney fees, and actual damages. Fines up to $10,000 a day for violations that continue after the administrative order is enforced for stopping doing it. And for willful violations up to $5,000 a day. So there's some big dollar fines for not complying with Reg Z. Community Reinvestment Act. Okay, so under the CRA is a Community Reinvestment Act. Lenders are expected to meet the financial needs of their communities, including investing money back into their communities. So a lot of times, like let's say PNC Loans, PNC Mortgage. PNC may have a program that if they're doing business in Ross Draver Township, that they have to invest money back into Ross Draver Township by maybe offering low interest rate loans to people who fit their income guidelines. You know what I'm saying? So they want the banks just not to take the deposits out of a community, Sarah. They want them to actually put money back in. Does that make sense? Ray?
What did the pencil say to the paper?
What's that?
What did the pencil say to the paper?
I don't know.
I got my eyes on it.
Okay, I like that. Okay. Ray, you have any other jokes? We need to bust things up here a little bit, Ray. We had some lifesavers. I don't know if Seneca ate them all or not.
You didn't give me any.
You didn't get none.
No, so I went and got my own candy.
How come you didn't get in?
You didn't
I
give
didn't
me
get
any.
any candy.
Did I walk right by you?
You did.
It's
Oh,
okay.
right.
You know what?
You gonna take
I
mine?
thought, did she buy
Look at Andrea.
No, it's
She can have
okay.
mine.
No. You're just gonna have to suffer through. And you know what, Sarah, you and Elise didn't get none either because you weren't here. But
I saw you looking over here.
I was gonna take yours back off you and give them the
I knew you were.
you seen that, huh? See, that's what happens when you work with somebody. They know you too good. Sorry about that, honey. I'll make it up to you. Okay? I don't know how. Maybe we'll give her an extra point or something.
Ooh.
Let's talk about the different loan programs. Okay? So what do you need to know about everything we went over just now? Let's go back. Fast forward it. Okay? Let me just go through these slides and stop at the stuff that I think is going to be important enough to be on a test. Okay? Factors that determine the interest. Okay, you need to know what yield and risk is. What yield?
Interest rate.
That's the return on the lender's. Let's just talk about it this way. That would be the return on the lender's investment. What would risk be when it comes to a loan? What's the risk that the lender? It would be the risk that the investment will lose money. Okay, and factors that determine the rate. I would know this because there may be a question, and it's just a whole multiple thing. What type of financing you're getting? Conventional FHA, VA, or USDA? The amount, right? Because jumbo loans carry more risk, and they're not even sold on the secondary market. So the lender is going to have to charge a little bit more for a jumbo loan. The lender's cost of money. What do you mean the lender's cost of money? Where does a lender get money if they need money? If a lender needs money, where does a lender get money? See, I'm worried about this class. Where do they get it?
Government?
What part of the government? They may be able to get it from a Federal Reserve. They may be able to get it from another lender, right? So the Federal Reserve regulates the flow of money and interest rate by increasing reserve requirements and the amount lenders can charge each other for money. The Federal Reserve. That's what this whole thing about interest rates is right now. If the Federal Reserve raises their rate's zero right now. So get this, a lender can borrow money off the Fed or off another lender. They can borrow money off the Fed or another lender at 0%. Okay? And the term of the loan. The longer the loan, is there more risk or less risk? More. Credit score. High credit score, low credit score. Which one gets a better interest rate? High. Okay. Underwriting. What the hell does underwriting a loan mean?
Goes in review with the bank. Right?
There you go. Goes in review. After Samantha gets everything done, she gets the appraisal done, she does her inspections, some underwriter at the bank's going to look at everything and put their stamp of approval on it. Then when that underwriter puts that stamp of approval on it, then they issue a loan commitment. And that's the formal pledge from the lender that they're going to lend the money. See, until the lender gives you a loan commitment, they're not pledging, they're giving you anything. You can get a pre-approval, but the loan commitment comes only after everything's been submitted and there's underwriting. Is this review helping, Ellen?
That's in unit.
Because I think the first time, I don't think anybody heard anything. I can go like this, look. And I think it would have did the same thing.
Money on the other side.
I mean, geez, a whiz.
We're all guilty.
Joe T emailed me.
What'd you say? 70?
She said 80% attendance, but a student may miss up to 6 hours of class time. More than 6 isn't incomplete.
Okay, well, if you do the math,
The math isn't right.
so which is right?
6
80%.
hours is too little.
Do the math for me.
I did.
And then we'll talk about
That's
the
like
break.
90-some%.
Right, so you can't discriminate because of race, color, religion, national origin, sex, marital status, or age. Could somebody 100 get a 30-year mortgage?
Yes.
How many days does the lender have to give you a letter on why you were denied credit if they deny you credit? 30 days. Ray, you're studying, buddy. And the law says you can get a copy of the appraisal, Samantha, if you do what for it? Pay for it. If some lenders, you don't have to pay for the appraisal. The lender pays for it. Okay, they'll probably charge a little higher interest rate to compensate for it. Truth in Lending Act is a popular name for the Federal Consumer Credit Act, and it was implemented by Regulation Z. You need to know this stuff. If I'm getting a $20,000 loan, personal loan, does Regulation Z come into play? $20,000 personal loan.
Yes. Oh, personal. No.
It applies to all loans of $25,000 or less for private consumers. Yes. Okay, bless you. It does not apply to agriculture or business loans over 25. So remember it this way, Chase. Personal loan under 25, yes. Business loan over, or land loan over 25, no. Okay? Anything that has real estate as a collateral, Regulation Z applies. Okay? You may need to know this too. And a creditor is defined by Regulation Z if they extend credit 25 times a year or more. At 25 just keeps coming. 25 if it's, or under if it's a personal loan, right? 25 or up if it is a commercial loan, correct? And a lender that lends 25 times a year would have to abide by Regulation Z. If a lender only lends 20 a year, he doesn't have to. Anybody that has more than 5 times a year, if there's a dwelling as security, or credit subject to a finance charge or payable in more than 4 installments. 3-day rate of rescission. Does it apply if you're getting a first mortgage or a deed of trust? No. No. Because how could that work? I mean, you would screw people up if trying to buy a house. Like if Ellen was going to buy Lauren's house and they signed a contract and you got the loan, you have 3 days to rescind. What is she going to do if she already bought another house? She's screwed. So with residential houses, there's no 3-day rate of rescission. And then there's those trigger terms, right? I would know them, Tam. When trigger terms are used, the following must be included: cash price, down payment, number, amount, and due dates of all payments, the APR, which is the annual percentage rate, or and the total number of payments to be made.
Wait, can you go back for 1 sec?
Where's that at in your book?
I don't see it.
It's in there.
Trigger terms are in 419.
Oh,
Oh, I got it, yeah.
Yeah, you have to look for it.
374.
370 what?
Or
See, I'm sorry, Seneca, that I didn't give you any lifesavers. You mean I walked right by you and didn't give you a lifesaver?
I didn't know who gave us those. I thought they were.
yeah.
I don't think you were here, Lex, but I gave him the one he could share hers with you.
Oh, you shared. She shared.
Where they at on 374? Right there. Top first paragraph. Specific credit terms such as down payment, monthly payment, dollar amount of finance charges, or term of loan are called trigger. Copy that up. Mark that page up.
I'll do that.
I'll be right.
I'm over this already.
Yeah, you're all rested up because you slept in this morning. We've been here slapping away since 9 o'clock this morning. Hard, dude, we're working hard.
I'm already over it.
2 chapters.
Well, you like to wake up at 6 a.m. and just talk on the phone real loud.
You're trying to sleep.
Yeah, it's great. I love it.
What's the Community Reinvestment Act
It's
about?
like a parent thing. I'm not a mom yet. I don't get it.
Moms just are like loud in the morning. I don't know. I don't get it.
Kids. Huh?
You know how he talks on the phone. Super loud.
You ring with her, Andrea.
It's like we scream after it.
Okay, let's talk about loan programs. Conventional loans. Typically, they're any loan that's not government insured, but they can be. So that's a little tricky. I should get rid of that. Loan to value ratio of 80%. So when I'm telling you, Lauren, the conventional can be anywhere from 5 to 20, I'm lying to you. You can't get a conventional loan from 5 to 20. And well, you need a lifesaver, Andrea. Or are you choking on those words where you were agreeing with Lexi? See, you're choking on those words, aren't you? So I think you need to just remember with conventional, I got to quit saying that, or 20 or 80% loan to value, meaning you have 20% down. And I'll explain how you can get 5% down on a conventional probably as we go through here. PITI ratios must not exceed 28%. Okay, what's PITI stand for? Principal, interest, taxes, and insurance. Okay, so the principal, interest, taxes, and insurance cannot exceed 28% of the borrower's income. So if a borrower makes $24,000 a year, and if they're getting a conventional loan and the PITI cannot exceed 28%, what's the maximum amount that guy could borrow? Get your calculators out and figure it out while I go over here and talk to Andrea.
So what did she say about that? She says. She said. Say 80% attendance for post completion, although we expect 100%. The student loans up to 6 hours.
If you do 6 hours, 6 divided by 75.
It's like 90%, but 60 hours would be 8%.
What was the 24?
Maybe she missed the
Total cost for.
The mortgage amount, I don't know. The person makes $24,000 a year.
Oh, okay.
That's what he makes. He wants to get a conventional loan. What would his maximum principal, interest, taxes, and insurance be?
So I think
75 for a year. That's 80.
80%.
Yeah, but what's the 6 hours?
Question then, email it back. Say 80% of 75 hours is how many hours it would be? What's the 6 hours? How's the 6 hours?
What is it, 6 hours or 80%?
Yeah.
She probably don't know, but she probably knows, but she's the one in charge. Okay. Anybody got an answer for me? Ooh, Azaria.
Is it 100,000?
How much?
100,000?
Well, I don't think so.
I don't think so.
I don't think so. That's a pretty big payment. You think if somebody makes 24 grand a year, they can afford $100,000 principal, interest, taxes, and insurance payment?
I thought you were talking about like the total like mortgage amount to it.
Well, you hold that note. Maybe we'll look at that. But what's the principal, interest, taxes, and insurance amount that this person would qualify for?
Is it 6,000?
I don't think so. That seems like a pretty big more. If somebody makes $24,000 a year, can they afford $6,000 a month for a payment? Hell, in 3 months, that'd be 6, 12, 18 months. They'd have their whole year's payment. Sarah?
It's $672.
Now that's sounding a little bit better.
That
672.
was almost right.
Is there any pennies?
I didn't get any pennies. but that's
Okay, so how do we get that number for you guys that are just biting on a chip to learn bit to learn some math? Okay, well, if somebody makes 24,000 a year, I would divide that by how many months? Well, what do you get? And I did 25 because it would be easy. How many thousands do you get? 2,000. What's 28% of 2,000?
How do you do that? What do you do?
Well, what's 28? Well, if they make 24,000 a year, your principal, interest, taxes, and insurance payment is a monthly payment, not a yearly payment. So if the law if the conventional financing, the maximum you can borrow is 28%, you take the 24,000 divided by 12, you get $2,000. Well, where's 2,000? Where's 28% of $2,000? Well, that's why you have to have a calculator.
I deal with that. I'm just asking how I do that.
Do 2,000 times 28%, Key. What do you get?
560.
Oh, we got a 560 over here.
Yeah, that's what
I got
I'm
that
doing.
down.
We got a 560. We got, how many 560s do we have? Put your hand up. 1, 2, 3, 4, 5, 6, 7, 8.
How'd you get?
How many 672s? We got two 672s.
I got that at first. You didn't get that. I got. No, because.
Ray, she just called.
Man, she like just, you didn't get that. You didn't get that. 'Cause you're-
That's a pride right now. See that, Ray?
You're doing cheating off her. She knows you didn't get that.
You didn't get that right.
So if I get my,
No, she got it. I know what you're saying.
if I get my calculator, I go 2,000 times 28% is 560.
If I take 24,000
But
times
see-
0.28, it gets you 672.
Zero, six,
Divided by
two,
12.
zero. But yeah.
All I
And
did
then you
was-
divide that 6,720, divide that by 12, and that'll be your monthly payment, which is 560.
Okay. I didn't know you had to divide that.
That's the long way around it, that's what.
Okay, cool. All I did was- I got you.
Well,
Right.
yeah. If you're looking for principal, interest, taxes, and insurance on a monthly basis, take the income down to the monthly basis and do the math. It's easier that way. I don't know of any other way to do it. You were talking about another way, but don't confuse the class because some of us are confused already. Okay. Now, so this person can qualify for a $560 a month payment. Maybe we need to do another one of those.
Okay. I was on the right track. I just forgot to divide.
109,000 is what the guy makes a year. What would his maximum under conventional financing is 28%? Because they may on a test just say, what's the maximum under conventional financing? You need to know the 28%. 28. Anybody 28 years old in here? Anybody close to 28? Anybody want to lie and say they're 28? Please, Christine, you're 28. Stand up. She's 28. She's the maximum mortgage amount for conventional financing a month. Okay, thank you.
But, never mind.
Okay, so if I make $109,000 a year, bless you, or me and my spouse make that combined, what's our maximum mortgage amount per month if I'm going conventional financing? That sounds right, Chris, bless you, PITI.
3,000.
Okay, so let's look. So we got 3,000.
Whoa.
Boy, James was quick to say no, huh?
Yeah, I'll
Man,
say.
he shut you down real quick.
No more peanut butter cookies for you.
Okay, Jay says no, but we have 3,000. Do we have anybody? Jace, what do you have?
I have $2,543.33.
$2,500.
$43.33.
Does anybody else have that? I would say, without me doing the math, that you were right. So how do you do that? For you guys that are not real, hey, I'm not real good with remembering people's names, spelling, pronunciation, but my math, I'm not that bad. But this math even throws me. So how would I do this? I would take the 109. So let me show you, Lex.
My thing is I'm gonna remember the one that's a 109.0 whatever, like the last time we did it, and it was like a different way.
Yeah, well, you
How am I
gotta
gonna know which way to do it? I'm never gonna remember.
use the percent key.
I'm saying, the last time we did math questions, we did it a different
Yeah,
way, so
yeah,
now, like,
different,
now they're just
yeah.
mixing up my head.
Well, there's a
We
whole
need
bunch
the,
of-
we need the circle table.
Anytime I see math questions, it's just gonna be one way, I'm not gonna remember
Where
seven
you
different
plug
ways
in
to
the
do it.
different, like it'll say like interest, blah, blah, blah.
Yeah.
You know what I'm talking about, the sheet that has all the different circle
And instead
formulas on
of
it.
that number, it would just be 109.0 whatever.
It'll have a way for
Yeah, but
interest. it'll have a way-
extra for that at your class, and I haven't got a tip. I didn't quit putting my tip jar out. Nobody brought me
You gave away
anything,
your tip jar.
you know?
I'm confused.
Yeah, nobody
On
got
what
me a
you're
tip
saying.
jar.
We got it the last time. We just did it in this class like 2 days. Well, yeah, but what I'm talking about, there's a sheet that he gave us with the different math formulas.
Oh yeah, I'm not remembering all that. Math
But
questions don't have to be
it'll
mixed up.
help you.
You know what, I'm afraid that math tables
I'm
may
guessing it's
confuse
I'm not
people even more.
No, it helps.
Did it
I
help?
remembered the formulas and I wrote.
Well,
it
I
down
haven't got
since I went
I haven't
away.
got a tip. Nobody brought me an apple. You know, a lot of times back in the day, you bring a teacher an apple. I didn't get
You said
shit.
you wanted that thing.
But you want
Yeah.
extra handouts. You know, I calculated the other day, you know, each piece of paper I print on my printer at home's 20 cents. Me and my grandson put ink in, and I figured out 1,500 cartridges you get. The ink is more expensive than the damn printer.
You do it at work and write it
Okay,
off.
what's that?
I said, can't you just do it in the office and write it off? It's for class. It's
Well, you know, everybody says you can write it off. You gotta make it before you write it off.
Well, yeah.
I mean, so the way you do this, well, is like this. So if you're trying to figure out what 28% of 109,000 is, but for PITI, make it simple. Know that this is the yearly income, but for principal, interest, taxes, and insurance, we want monthly income, okay? And I'll tell you what I'll do. After the finance course here, everybody can thank Bonnie. I'll pass out the table she's got.
It helps.
Okay,
It
so
really
I'm gonna
does.
go take 109,000. Okay, Lex. And if I'm trying to figure out monthly,
I know, I got
I'm
it.
gonna divide that by 12. And
She's saying that every different formula is different.
there's all kinds of different shit in math.
I
Yeah.
can't remember any of them.
Yeah, you'll be okay. You don't have to get any math questions right.
Yeah.
So I would divide that by 12, and I get $9,083, and then I would just multiply that by 28 and then hit the percent key, and I got $2,543.33. So is that how you guys did it? Okay. I'll pass the math. Let me get through this section first, and I'll pass the math things out.
We got the math list over here.
Yeah, she's good at math. Okay, so conventional financing is 80% loan to value, right, Lauren? Not 5, 80, right? And PITI ratios cannot exceed 28%, right, Jared? So what's the maximum principal, interest, taxes, and insurance payment on a conventional loan of the person's income? 28%. But you can get what we call private mortgage insurance. And private mortgage insurance will allow a conventional loan to finance up to 97%. I said 95, didn't I, Lauren? But they'll even go 97 or even 100 in some situations. I don't know about that, but maybe. But you have to get additionally a security for the loan for the lender is provided by a mortgage insurance company. Okay? So this is how it would work. Conventional financing, right? They like 80% down. I mean, they like no more of a mortgage amount than 80%. So on a $100,000 loan, on a $100,000 purchase, Lex, if you're purchasing a house for 100,000 and you're getting a conventional mortgage, what's the maximum mortgage amount you can borrow?
I don't know.
Yeah, you were on the right track here.
80?
It's 80%, so what's 80% of 100,000?
I don't know.
Okay. Does anybody know? 80,000. Some people just weren't good with math. That's okay. I'm not good with names. I don't care. I care, but I'm over it. So that would be 80%. So if you don't know, like real easy, you have to use your calculator. So get your calculators out, put 100,000 times 80%. And what do you get? 80,000, right? How much would the down payment be in this case? 20,000. Okay? But we call that 20% down. Okay? But the way it works is you can still get a conventional loan if you ain't got the 20 G's to put down. And how you do that is you can get private mortgage insurance. So we said that the lender, now why does the lender like 80% down? 80% maximum loan to value with 20% down? Because they figure if you're buying a house for 100,000 on the open market and you don't make your payments, they should be able to take that house back off you and at least get 80 grand for it. Right? That's why a lender likes this. But they're saying if you want a conventional loan and you don't have that 20% down, you can still get it, but you have to get a private mortgage insurance company to insure the balance. So if they want 20% down in this case, okay, and you only have 5% down, okay, what's 5% of 100,000? Raise on it. But they want 20% down, don't they?
Right.
Samantha, don't they? So, but you only got 5, but yet you want a conventional loan for some reason. There's a company, they call them private mortgage insurance companies, that will insure the lender the difference between this and this, which would be $15,000, and they'll insure the lender that $15,000. Private mortgage insurance company. Okay, so a lot of times they want to make sure. Excuse me. Sometimes they'll even insure 25 or 30% of the loan for the lender. So this is an insurance for you, Jason. Who's this insurance for? With private mortgage insurance. For the lender. Okay? Because some people may want a conventional loan for some reason. Sometimes the condition of the house. You can't get an FHA or VA or USDA loan because they want to make sure everything's in good shape. Conventional is a little bit more lenient because you got a bigger down payment. Okay? So sometimes you want to get a conventional loan because of the condition of the house. So, but you don't have the 20% down, so you can get this private mortgage insurance. Now, the termination of the private mortgage insurance, the law requires that once the PMI is, once you have 22% equity, the PMI is terminated because you pay for that private mortgage insurance. You pay for that. You're going to pay the private mortgage insurance company so much a month.
That was gonna be my dumb question.
You pay them so much a month for insuring to that lender that you're going to pay the difference. Okay.
So,
And if you just Google, everybody Google on their phone, how much is the private mortgage insurance rate on a conventional loan? Put it in your phone. Google it, Squirrel. You'll remember it if you Google it. How much is private mortgage insurance for a conventional loan? Okay, now don't go to the ads. I don't know, when you Google, I never go to the ads. I always scroll down. So the first one I have comes up from Rocket Mortgage. Does anybody see that? Private Mortgage Insurance, a guide to PMI. PMI, like other types of insurance, is based on the insurance rate that they can charge daily. PMI typically costs 0.5, which if you're not good with math is 0.5% to 1% of the mortgage amount. So they're saying, so if it's 1% of the mortgage amount, you could do the calculations to figure out how much the PMI percentage is. So if it's an $80,000 mortgage amount, right, guys? Because the purchase price was $100,000, and you want a conventional loan, so you need to put 20% down. So the maximum loan to value is $80,000. What's 1% of 80,000? 800. Divide that by 12, because there's 12 months in a year.
66.
There you go. That's how you figure out somebody's private mortgage insurance payment. Now, it could be half of that, because they said 0.5 point to a point, right? 0.5% to 1%. I use the percent to make the math easy. What's that?
That's not bad.
No.
So what they loan the money to you or? to
No.
they just-
You pay that insurance. So you're going to pay, if you only had 5% down, if you only had 5% or $5,000 down, but you wanted a conventional loan, you'll pay $66 a month to this company. And if you default on the loan, they'll make the bank whole up to the 80%. Not a bad gig, is it? Okay.
So then if it gets foreclosed on, does the PMI, does the insurance company get to do the foreclosure? If they're guaranteeing it?
It depends on who would have, who recorded first. And I would think that the PMI probably has to sign a subordinate clause stating that the mortgagee gets to get the money first, and then the mortgage insurance company would get it second. I would assume they have to do that, because the mortgage company is going to be out $80,000. The mortgage insurance company is only out 15. So I would think that they would subordinate. What's it mean when I say subordinate their position? Okay, look the term up in the back of the book, what subordinate means.
Oh, I think like take their job away or something.
No. Whoever gets it, yell. Bless you.
I know what that word is, but I don't know.
What's it mean when somebody subordinates a loan position?
They're ranking by order of importance.
Loans are ranked by typically the first to record.
Changes priority of the mortgage.
Subordinate?
Says the subordination clause. Holders of the liens on a property, it changes the priority of the mortgage.
It changes the priority. So if you did a loan and you had a PMI, probably the PMI are going to put a lien against the property at the same time the mortgage company is. So the mortgage company is going to say, since we're lending them 80 and you're only lending them 15, we need you to subordinate your position so you would be second in line if there's a foreclosure. So that's what that means. You're subordinating your position to let somebody else jump ahead of you to get paid first. I hope I'm not spending too much time on this finance course. FHA loans. Let's take a 5-minute break. 5 minutes.
I don't know you for that. It's weird.
Sorry.
Favorite ones too.
They're just all so good.
These are good.
Woo. I'm glad I looked at this. 10% of your state exam is going to be on financing.
See, so we do need that paper.
10, okay.
You're welcome, guys.
10%. Hands ready to go out and smoke a
I know I
cigarette.
had one, yeah, I was like,
I need 3 volunteers to pass it out. Vaughn, you're going to be one of them.
I guess I deserve that.
Lauren, you're getting ready to volunteer. I like you. You know, you're a nice person. Thank you.
You're a nice person also.
Oh, it's a blank one.
And you can pass out this one. Thank you. Give everybody one. Don't worry. Everybody got one. Don't worry about what they're passing out, Vaughn. You pass out yours.
That's the one.
20 cents a copy, man. You're killing me. Just take all 3 of those. Don't pay any attention to them. Put them on the side. I said I'd pass them out. I didn't say I was going to explain them. But the next math question will explain them.
It's really nice out there when the wind's not blowing.
I know, it's beautiful out. Hey, we're almost halfway through February.
Yep.
Make sure you at least save one for me. Thanks, Christine.
Yes.
Okay. Put them on the side. Did JT ever email you back?
The last one?
Yeah, because she gave us 2 different answers. She don't know now.
Oh, wait, I gotta give you one.
That's okay, just leave it in there. I just want to make sure there was one in there. And maybe we'll go over these today. Okay. A couple more minutes and we'll get there. Let me see if I got any snacks. I brought some snacks for you guys. You know what? I wanted to get into another chapter, but I think we need to spend just a little bit more time on his financing, huh?
Well, I'm glad you like it.
Okay.
I got with my friend that, you know, when I was here,
What's going on? What's going on?
Even when I washed it, since I hasn't gone
You
in
look
there.
right all day.
I didn't hear it.
There's some fur around in my eyes.
Oh, what's wrong with your eye? What's the problem?
You looking right all day.
It happens rarely.
Hard.
Way back in style.
Hard.
I have to be at
Any
work.
ladies like
Oh,
razors?
check this first up. Yeah.
Razors? You like razors? How about a day? I got that off of
Oh, those are some really good pickup lines.
That was off of Ward FM.
You
so-
use these pickup lines?
No, that was, no, but actually I probably would because it's just funny,
Yeah.
you know, but I heard it on Ward FM. That's where I got it. They always throw some.
Makes
corny-
laugh.
Hey, you know what happened to the cat that swallowed a yarn ball? Lost his mittens.
You look like a car salesman.
Do I?
Yeah.
Thank you.
I feel like if I saw you in Walmart, I'd be like, sells cars.
Yeah.
Well, I'm now an official, going to be a real estate.
Yeah, you're
I
just
might
a
go
salesman.
back- I might go back to, my buddy just offered me a job at, out there in Bentleyville at the Ford store.
Yeah.
He's a manager, Johnny Mucho, who used to live in Kenny Ross. He called me up. He's like, "Hey Ray, I got this opportunity for you. There's only 4 guys at the store." And that's what I couldn't stand, because they would flood the floor. They had you like chicken hops, where you couldn't get a customer.
So it's like, what
I grew out of that. I said, you know, I've had enough of it.
yeah, when everyone's running to one customer.
Thank you. That's just cheesy, you know. And plus it offends people. You know, they don't like you happen to come out to the door. It got to where I had to go out and almost open their car door to get enough.
Yeah.
And that's not.
That's like a furniture store. When you walk in, they're all like, "Do you need anything?"
Yeah.
I'm just like,
Hey, here's some chocolate my buddy from Florida sent me.
Life is like a box of chocolate.
And these are chocolate covered chips. Chips.
Chocolate-covered
They're good too.
"Oh."
So you guys can dig into these.
Thank you.
It's dark chocolate.
Oh man, it's good for the brain.
Chocolate-covered raisins or something I
Good for
really hate.
brain.
I want to eat the chips.
Yes.
I've never had a chocolate-covered chip. There's a place in Waterloo, Dorothy's.
I'm gonna get
Dorothy's.
Yeah, Dorothy's does a potato
You
chip
keep your
log.
envelope
We had it
together.
at work one time. It was a log that was potato
Okay.
chip chunks in it. Yeah, it was pretty good.
So I do have study guides, but again, these just don't come with the course. So I better see some tips or apples up here, or little shots of Kahlua. I like those better than anything. And I was giving my wife, I told my wife, I said, you know, Nick, Lex came first day of class. She came in late, wanted to rip shots. She says, well, you drink Kahlua there in class. So I do have study guides. I pulled a PSI list. If you go to psi.com, you'll be able to pull these off. But mine's a little bit better because I have it broken down to what page everything is on. So this, I will give you these when we get towards the end, because this is what I want you to take home and use to study for the state exam. And it has a total breakdown. For example, property ownership has 8% on the salesperson's exam. And when I just contracts, 17%. So this will give you the areas in that book where you, and then it even has what page, like requirements of a valid contract, page 151. You need to know that for the state test. So here's complete break, transfer of title 8%, leasing and property management. There's only 3% on. So I think we have that chapter coming up, don't we?
Yeah.
Yeah. And you know what? When is that the last chapter?
Property management.
Leasing and property management. So I got 60 slides on that, but there's only 3% of the test on it. So I may even just tell you, read that unit at home, do the test, you know, if we don't get that one out before Tuesday. There's only 3 on leasing and property management.
I remember thinking that.
Yeah, the practice of real estate salesperson, 3%. Real estate calculations, 10%. Basic math. So I'll give these to you when we get closer. I don't want to give them to you now. And I have copies made for everybody to help. My goal is to help you get through this darn thing. Help you get through this test. I want to help you get through this test. So when you text me and say, I passed the test, like Sheila did, I can say, ooh, I'm happy. I'm happy. If you get an answer back from Joe T, let me know. Okay, so we talked about conventional loans, right? What's the maximum loan to value for a conventional loan? Loan to value. Maybe I wasn't clear with that term. Loan to value for an FHA loan. I heard somebody chime in say that. I mean, we've been talking about that the whole time here.
Conventional or
Need some chocolate. Everybody needs to go up there and get some chocolate.
Life is like a box of chocolate.
What's the maximum loan to value on a conventional loan? 80%. That means on a $100,000 purchase, the maximum you can borrow is how much? Which 80% of a, put it in your phone if you don't know. What's 80% of 100,000? 80,000. So what would be the maximum down? If I give you a question on a test, purchase price is 100,000. You're getting a conventional loan. what's the maximum down payment you need? 20,000. It would be 20% would be the down payment. The loan to value, the loan relationship to the values can't be more than a maximum. This helping you, Lise, like drilling down in this stuff. If you don't have 20% down, who can I pick on? Ray. Can you still get a conventional loan?
Yes,
What do you need?
5,000.
No, what's the name of it?
Convention.
No, if you don't have 20% down on a conventional loan, but yet you still want a conventional loan, what do you need? And which PM, you have to know the difference, because FHA is gonna have a different one. So you have to know PMI, not PMS. PMI is private mortgage insurance. Know, Sarah, that PMI is private mortgage insurance, and it's used on conventional loans. Okay? Private, write that down or something. Okay. And on a conventional loan, what is the maximum principal, interest, taxes, and insurance, or PITI payment a borrower can have? What percentage of their income?
28.
Okay, now you know they're going to trick you every time, right? They're always going to say 28%. A guy makes 100,000, and you're going to think, well, what's 28% of 100,000? That's going to be one of the answers, because I heard somebody chime out 100 grand, right? They're going to always do that, but you have to remember the principal. When you make a mortgage payment, you make a car payment, you pay principal and interest. When you make your car payment every month, you make a principal and interest, because you don't have taxes. And your mom pays your insurance, but an insurance, but you know what I'm saying? But you pay it, but you know what I'm saying? But so with a car, you have to get insurance, but Ray, you were in the car business,
Yes,
but they don't roll the insurance into your payment.
No, they do not. It's a separate entity.
But you have to keep insurance. So with your car, you pay principal and interest. With a house, you have to pay principal, interest, you have to pay property tax. If anybody here do not own a house, put your hand up. See, none of you guys pay property tax. Who owns a house here? Put your hand up. You pay property tax, don't you, Tam? Every year you get 2 tax bills.
Even if your house is paid off, the government still owns it.
Even if your house is paid off, don't have nothing to do, you still pay taxes.
Yeah.
And insurance you have to get the loan. Lexi, you have to get insurance on your car loan, but it's not rolled into the payment. A lot of times with mortgages it is. So they're going to try to trick you and say, guy makes 100,000 a year, what's the maximum principal, interest, taxes, and insurance he can have under conventional? You need to know it's 28%. Do we have that down pat, Lauren, do you think? And I confused you when I told you, I think early on, that you could get a conventional loan for as little as 5%, because that book's saying you can get a conventional loan for as little as 3% down, and maybe even 100% if you pay that private mortgage insurance. So that's conventional. Anybody that gets this answer right gets a point.
Another lifesaver?
I'm out of lifesavers, but I don't know. I just get a point. I don't know what these points will be good for, but you may be surprised. Now, if you know the answer, you put your hand up. On the secondary market, what is the secondary market? Tam?
That's where banks sell their loans to.
Banks pool their loans. Like they'll sell 10, 20, 30, 100 loans, and they sell them on the secondary market. And who buys them on the secondary market? A conventional loan. There's 3 entities that buy loans. There's Fannie Mae, there's Jennie Mae. I like that Jennie Mae. That's just a nice name. And then there's who? Freddie Mac. And who buys typically conventional loans? Freddie. And then Freddie pulls them up and sells them on the secondary market. Okay, so conventional loans, Freddie Mac would typically buy those, and then that frees the lender up to lend more money. Now, Samantha, some lenders don't sell on a secondary loan. They keep the loans in-house. What do we call that? They portfolio the loan. They keep it in-house. They just lend their own money. And a lot of times, like credit unions, Charleroi Federal, Washington Federal, those kind of lenders, they just lend their own money. They don't sell their loans on the secondary market. So where do they get the money for the loans? From deposits, right? And that's why there's that community redevelopment, whatever it is. What do we call that? We talked about that. That requires banks to invest in their own communities. What was the name of that? You may want to know that.
Community trust.
What was it?
Community trust.
Reinvestment Act,
What is it?
Community Reinvestment.
The
Act.
Community Reinvestment Act. And what are the initials for that? CRA. Where lenders, because they're taking deposits, are required to put some money in. So a lot of recap we were going through. But now that I've seen that there's so many questions on a state exam with financing, I figured I better slow it down a gear and really drill into this for you. If we just do financing the rest of the afternoon, I think I'll be happy. Okay? Because it's confusing, because this isn't easy breezy like those first two units we did this morning. So you missed the easy one, Squirrel. You didn't miss much. They were easy breezy. I'm sure you'll listen to your daddy's YouTube videos tonight to get caught up.
Yeah, after work, that's what I'm gonna do.
Yeah. What time do you go in?
5.
5. So then there's FHA insured loans. Who buys FHA loans?
Federal Housing Authority.
No, Fannie Mae. Then Fannie Mae would pull them up, sell them on secondary market. So the FHA loan stands for the Federal Housing Administration, and it insures low down payment loans with high loan to value ratios. And we know loan to value ratios determines the mortgage amount, right, Tam? More affordable loans are made. Didn't we watch a video that said that in the 1950s and even before that, you had to have like 30, 40, 50% down. You only could finance for a few years. So only the rich were able to get loans. And then after maybe the war or something, the FHA came out and with FHA loans to make it much more affordable for people. Well, who put the hand sanitizer up here by the chocolate? Did you do that? I think it's a nice move. I'm a little considerate with coronavirus with this class. It's the first class we've done since the pandemic. And I'm glad that we're not having any problems with it.
Yeah, no.
If somebody's sick, just don't come in. If you're not feeling it, don't come in. If you test positive for corona, don't come in and follow the CDC guidelines. The CDC guidelines state that anybody that you're within, what is it, 6 feet? 6 feet for 15 minutes, you have to call them up and tell them, hey, you got the corona. Imagine craziness. So the FHA came out in about 1960. Does the book tell you when the FHA came out? No?
In that back chapter, on those first ones.
When did they come out? Help you remember it. Because conventional loans have been around for a long time. It don't matter because it's not going to be on the test. But it's just a fun fact. Okay, don't worry about it. It was on one of those, maybe 1960. So the FHA came out because the only people who could get loans before, and they were conventional loans, were people with money. So they wanted people with, and that's when, remember we talked, most people lived in company towns. Cokeburg, when did they come out with FH?
It says Congress created FHA in 1934.
1934, after the Great Depression, right? Dave, he'll know all them dates. Dave, Dave's smart. He's like, they take an IQ test. He's like in the top 90. He's the top 5% of the whole world. So you'll love Dave. He'll know all this shit. He won't have to look nothing up. He's just smart. So you'll really like Dave. This is perfect timing that he's going to do the review for you guys. Can you go on Dropbox and then go under corporate crash course and make sure that that PowerPoint is there and the PDF that you're going to have to print out? Because you're going to have to bring all those, set everything up. Dave's just going to walk in here, show him how to hit the button. Real smart, but not real computer literate. No, I'm just teasing. Don't tell him. You can't.
It's on recording.
Oh, he can hear me.
When is
Okay.
he coming in?
Sorry, Dave.
When is he
Okay.
coming in?
Next Thursday. So, FHA came in. They have low down payments, higher loan to value ratios, more affordable loans are made to the public. Loans are made by approved lending institutions. You have to be an approved FHA lender. And FHA loans are more attractive because the interest rate's competitive with those at other types of loans. It's not as good as conventional, Jace. So an FHA loan, because there's more risk, would have a higher interest rate. But it's not much higher, maybe 0.5%. And when we say point in this business or in the banking business, a point is 1%. And if you're paying points on a loan, each point would be 1% of the mortgage amount. You know, you hear that on The Sopranos. Hey, Tone, I want to borrow some money. Okay, man, I'll charge you 5 points. Well, that's 5% of the loan amount. Okay.
There's a PowerPoint and handout.
Is there a PowerPoint handout? So you're going to have the PowerPoint loaded for him, and you're going to have the handouts printed out to pass out.
Yep.
1 for Dave, enough for the class, 2 extra, just in case somebody comes. 3 extra maybe.
Is it the max points is 3.5 or 3, something like that?
I don't know that. We'll see if we get into that.
No problem.
Okay. So interest rates are competitive with other loans, and they have 15 and 30-year terms available. And they also have a 1-year adjustable rate or fixed rates. So what's an adjustable rate mortgage? Does anybody know what adjustable rate? Oh, Tammy does.
Well, the rate changes.
The rate changes. So fixed rate, Lex, you got a fixed rate loan on your car. Whatever the interest rate was when you negotiated that with the bank, whoever you financed it through, they gave you a fixed rate. So that interest rate doesn't change for the term of your car payment. And a lot of times you can get a fixed rate mortgage that over 30 years doesn't change. I mean, if you can get a 30-year mortgage fixed rate right now, you're in good shape because rates are low, 4%. But then they have a vehicle they call, or an instrument, I should say, adjustable rate. An adjustable rate would move. So you may get 3% the first year, and then it's based on something, maybe the Treasury T-bills, and as they go up, the interest rate goes up. So you may get 3% this year, but next year you may pay 4. The year after, if interest rates are going up, you may pay 5. The next year, if interest rates are going up, you may pay 6. Then if they keep going up, you may pay 7. Then they may cap at 8. That's an adjustable rate mortgage. Now, when adjustable rate mortgages are very popular are when rates are high and going down. Because if rates are, when I got in the business, rates were 12%. So a lot of people, but they came off of 18. So they were going in the right direction, right, Lise? They were going down. So a lot of people would get an adjustable rate mortgage because they got their mortgage for 12% today, but next year it could be 11%. And the year after that could be 9% because rates were going down. But this is a rising rate environment if you pay attention to the news. I don't watch the news. I try not to. Rates are going up. So if you got an adjustable rate mortgage today, I promise you 2 years from now, you're going to be paying higher. But some commercial loans are adjustable rate. You can get residential loans that are adjustable rate, okay? The FHA has limits on the maximum mortgage amount, okay? Which are set by regions to reflect housing prices in the area. So how much is the maximum FHA mortgage amount right now? It doesn't matter, but I think it was just increased to maybe like close to 600,000. So the FHA, and by regions, because California, Jace, they'll have a higher FHA rate because housing prices is higher there. In certain regions, they have certain maximum limits. On an FHA loan, since the down payment is only 3%, how much is it on a conventional? How much? Yeah, we should just say 20. But we know you can get 5 if you pay or less with private mortgage insurance, because I think that's how they'll trick you on a goddamn test. So, but with FHA, it's just 3% down. Because it's 3% down on a $100,000 loan, what would the maximum loan to value be? FHA. Don't yell it out. What?
3.5 in the book.
3.5? Okay.
I thought you said it was 80. What was the 5 and 20? 5 and 20?
What's that, honey?
I thought you said it was 80. Now what's
80 is conventional.
Okay.
This is a whole different type of loan. This is an FHA. So I do need to get somebody on the phone then, because maybe I need to change my PowerPoint if it went to 3.5. So this is why you always need a mortgage person in your back pocket. You know, I got to start bringing my little. Can you text me to start bringing my little boom box thing so I can Bluetooth it from my phone so they can hear the conversation?
Yeah. Just say 20. Forget the 5. Just say 20.
Okay. So I'm calling my a mortgage originator that I do business with. No answer. Okay, so that's why you always have 2. See if this guy answers. So the book's saying 3.5?
Yeah.
They may have increased it.
Well, I have an old book that says 3.5.
What's the old book say?
It says 3.5. It says 3.5 also.
Holy shit, I can't get anybody on the phone, can I?
Well, do you know?
Yeah, that's why you have to have 3. But one of those 2 guys will call me back. So the borrower pays 3.5%. So if it's 3.5%, and it'll take me years to adjust from 3, what would the maximum loan to value be on a $100,000 loan? Don't burn it out, because I want everybody to get their calculator out and figure it out.
What do we figure out again?
What's the maximum loan to value on a $100,000 purchase if the guy is getting an FHA loan? Okay, don't worry about it. That's what we're going to do. Okay, has anybody got the answer?
Wait a minute.
Are you looking at that chart I passed out, Vaughn?
Yeah.
Don't look at the chart I passed out. Don't look at it. Put them down, put them down, put them down. This is simple math. You don't need a chart to figure this out. If the purchase price is 100,000 and you know the FHA guidelines are 3.5% down, that means the loan to value would be 96.5, right? 96.5 plus 3.5 make 100%. So what's 96.5% of 100,000?
65.
How much?
65,000?
No.
No? I did it wrong.
Did anybody get 96.5? Yeah, get your calculator out. Type in 96.5 of, multiply that times 100,000. See, you guys ain't used to doing the math. It's not, don't be bad, don't feel bad or stupid that you don't know these questions. That's why we're here today. So the maximum, the down payment on an FHA loan is 3.5%, right?
Yeah.
So what would the loan to value be?
96.
96.5. So if the purchase price was 100,000, the maximum FHA loan would be 65,500, 96,500.
Okay.
Everybody got that? Did you get that, squirrel?
Yeah.
Okay, I'm gonna give you another one.
Oh.
I'm gonna give them to you until you can get it, and then you'll know how to do it. Okay? Because some people are easier with this than others. If the purchase price of the house is 150,000, what's the maximum FHA loan to value?
Am I supposed to divide it?
Okay, so how I'm gonna do it, let me show you how I'm gonna do it, because I'm not gonna ask for any answers yet. If I know the maximum FHA is 3.5, right, Jace? Then I know the maximum mortgage amount, because I take 3.5 in my head minus 100 is 96.5, right? Am I right on that? So then, if I want to find out the maximum loan to value, and I know FHA is 3.5 down, so the maximum loan amount's 96.5, I'm going to take 150,000 times 96.5, and then hit the percent key, and let me see what I get. 150,000 times 96.5, and then hit the percent key. Oh, that's not the way to do it. 150,000 times 96.5% is, how come that's not working for me? Look, I'm struggling, squirrel.
144.
Wait a second, what the hell's going on here? 96.5. Times 150,000 is 144,750.
Yeah.
Now, why didn't it work the other way for me? Are you guys finding out that? Let me put that in my calculator again. So if I try to put the 150,000 in my calculator first, and then multiply it by 96.5%. Oh, I got it. I don't know. It must have been user error on my
You
point.
might have been holding your finger on it. And just
I was holding my finger on something. I'm not sure what. Okay. See how I got that, squirrel? Did you get it now?
Mm-hmm.
Okay. Let's do one more. And I'm going to change the math up to make it a little bit difficult.
Let's do a million.
245,500 is the purchase price. Okay? What's the maximum loan amount? Conventional financing. Conventional financing.
You say we're doing FHA?
I snuck a conventional in, trying to confuse you. You had to call me on that.
Yeah.
I said it low too,
Yeah.
didn't I? What's the maximum loan about conventional? Because how much do you need down conventional? What's the maximum loan amount? Conventional financing is 80%, right? FHA is 96.5. So if I wanted to know the maximum conventional, what would be the maximum loan amount, right?
I think it's 185, 560.
185,
Ideal.
560. So what I'm gonna do is I'm gonna get my calculator out and I'm gonna put 145,000.
She's saying, Bonnie's saying it's not right.
And with conventional financing, I know it's
Times it by
80%.
80%, and that's what you got?
196 I got. Anybody else get 196? Okay, see how I did that,
Wait, how'd you
squirrel?
get that number?
I just did 16.
That's okay, I got it wrong myself a couple
So what
times
was it?
before.
80%.
80 is conventional.
Times it by 80.
Times, okay, yeah, right. That's
Why 80, Ray? Because I snuck in conventional.
Right, you did. You're right.
You did 60%?
I got, now,
I just did 20,000, 60,000 minus.
Okay.
Oh, okay.
So
There
now-
you go.
now,
You're
what
making
would
it
the
harder.
maximum
to
loan
spread.
amount
Yeah,
be
exactly.
if the guy is purchasing a house 145,500 and is getting an FHA loan?
Say 96, right? 96.
That's okay. We're gonna spend some time on this. You guys are you're gonna be a math expert. Because this isn't stuff you do on a daily basis.
Bonnie, you said that was 196.4, right?
What?
What was your number one?
On the last one?
Yeah,
I don't remember.
196.
196 something,
yeah,
yeah.
okay, I got it. Just wanted to make sure. So.
I just gotta remember your numbers.
What's the FHA maximum loan to value? Know that on conventional, it's 80%. No, on FHA, it's 96.5. So what'd you get?
236.
236,000.
907.
So conventional, 236, what?
907.
907 on the FHA. So
Sounds like your squirrel.
what's that?
Sounds like your squirrel.
So if I have a purchase price of $245,500 and I'm going conventional financing, how much would the down payment be? Would- 49,100. Okay. Because we know that the down payment on conventional is what percent? 20. We know that the maximum loan to value on conventional is what percent? 80, right? 80 and 20 make what? 100%. What's the maximum loan to value on an FHA loan?
96.4.
Loan to value,
96.
96.5. So what would the maximum down payment on an FHA loan be? What?
3.5.
3.5. So how much would the down payment be on a FHA loan for a $245,500 property?
$8,592.
How much?
$8,592.
$8,592. I know my little squirrel is a little saver, just like a squirrel saves nuts. She saves. She's a little saver.
Would you divide that?
Lex, you could you probably haven't, I know you have enough money saved up, and you've only been working for a short period of time to buy a $245,000 house with FHA financing, because you only need $8,500 down. So that's why they started the FHA. How many people do you know can afford $49,000 down? That's a big chunk, right? So with an FHA loan, you only need $8,592 down. Are you out?
I'm out.
You're out of the house?
Yep.
Get the hell out of here. But with the FHA, borrowers pay a upfront FHA insurance premium called MIP and a monthly or annual payment. So with private mortgage insurance was with what kind of loan? PMI. Remember? I said PMI, not PMS. Right? PMI, you only paid a monthly fee for conventional. But with FHA, you have to pay an upfront and an annual fee. Okay? And that's called mortgage insurance premium, MIP. You got to know the difference. MIP is for what kind of financing? FHA. PMI is for what kind? Conventional. PMI, you only pay monthly, right? Shake your head yes. MIP, you pay upfront and monthly. Okay? So, and that could be added to the loan amount. You're upfront with an FHA loan. So your upfront premium, Jace, on an FHA loan can be added to the mortgage amount. And then you would only pay a monthly fee or an annual fee.
What does MIP stand for again?
MIP, mortgage insurance premium, probably. Mortgage insurance premium, yeah. The annual payment may also be due depending on the loan to value ratio and term of the loan. And typically the annual payment's divided by 12 and you just pay it monthly on an FHA. So an FHA is going to have a little higher mortgage amount because of the risk, right? So the yield the lender is going to charge is going to be a little higher. Plus the mortgage amount could be a little bit higher because of the upfront mortgage MIP is added to the loan amount.
Question.
Yeah.
If you have an FHA loan, can you refinance to a conventional loan?
Absolutely.
And vice versa?
Yes. Yes. Okay. So let's talk about the FHA loan program. Because conventional loans, when I borrowed money from my real estate office, I got a conventional loan. Remember I told you I got an adjustable rate when I got mine. Okay. Because sometimes with commercial loans, they'll only give you an adjustable rate. Okay. But with FHA loan, the criteria is it has to be owner occupied 1 to 4 units, or you can't get an FHA loan. So could I get an FHA loan on my office, Lex? No.
Unless you live there.
Nope. It has to be 1 to 4 unit family residence. It can be for repairs or rehab. So I snuck out of here at lunchtime of single family properties. So because they have a program, FHA, it's called the FHA 203K program, where, because the FHA wants to make sure the house is in good condition. Why? The lender has more what? Risk. So the FHA is going to say, we want to see with conventional, you can get a conventional loan. Remember I said sometimes people, because of condition of the property, have to go conventional. If you have a hole in the roof and you can look up and see the stars, you can get a conventional loan. Okay. But the FHA wants to make sure you got a good roof. They want to make sure all the windows work. They want to make sure you got ground fault breakers in the kitchens and bathrooms. They want to make sure you ain't got no peeling paint. Why do they want to make sure you ain't got peeling paint? What does peeling paint cause? Lead-based paint, right? They want to make sure the furnace works. You can get a conventional loan if they stole the plumbing out of the house, not an FHA. Okay, so FHA come out with a program called 203K where you can buy a house that has a hole in the roof. You can get an FHA 203K and you can borrow money for the repairs. It's a good program. So at lunchtime, I snuck out of here because I had somebody that wanted to get into the real estate business, and Cindy was interviewing her. And I like to meet everybody. Most of you guys I probably met if you came in my office for an interview. I tried to, and I was all excited. She's from Denora, and she works with children, and helps them, not only give them a meal, but they give them guidance and so forth. And then I said, why do you want to get in the real estate business? And she says, I want to help people. And I said to Cindy, I says, you know what, she would be good for the FHA 203K program because you can get houses that are in bad repair and people who don't have a lot of money can still buy that type of house and finance the repair. So here's one of my finance guys called me back. Tom, how you doing, my friend?
I'm good. How are you today?
Good. I called Susan first, then I called you just to let you know. And I'm teaching a class right now, and I have a whole bunch of people listening to you.
Okay.
And Tom, what mortgage company are you with?
Stockton Mortgage.
Stockton Mortgage. So I got about 20 people here are going to be getting their real estate license. Do you want to give them your cell phone in case they have any mortgage concerns? They can call you.
Absolutely.
What's,
Here to answer any questions.
his name is Tom McWilliams with Stockton Mortgage. What's your number, Tommy?
412-613-5511.
And if they come to our office, they'll be working with either you or Susan, correct?
Yes, sir.
Okay. FHA, what's the down payment requirement for FHA loans now? Is it 3.5%?
Yes, sir.
I thought, when did it change from 3?
It's been 3.5% for, it's been a long time.
Okay. Thanks, Tom. Make the instructor look good. I was telling him it was 3%. One of the students, you always got one of them smart students in the class. And they said, oh, no, the book says 3.5. I said, I'm going to call Tom McWilliams and find out. So with FHA financing, you can finance 96.5%, correct?
Yes, sir.
But with FHA financing, you will have a upfront MIP, mortgage insurance premium, correct?
Correct.
And you can roll that into the loan.
Correct.
And then you have a annual MIP payment that's usually divided monthly, correct?
Yes.
Okay. Okay. And with conventional financing, they require 20% down or 80% loan to value, but you can get mortgage insurance to cover the spread if you only have 5% down.
That is correct.
And with mortgage insurance, you only pay a monthly fee, no upfront. Okay. Okay. Okay, listen, if I have any other questions, Tom's a great guy. You have his phone number. Even if you don't come work with me or whatever company you go work with, I would write Tom McWilliams' numbers down because he at least returns phone calls. Thank you, Tommy.
Thank you, Tom. You guys have a great day.
And thanks for yesterday. It was a great event.
That was a great time. Thank you.
Thank you, my friend. Bye-bye.
You're welcome. Bye.
So, are you getting the difference between FHA and conventional?
Yep.
It can be for repairs or rehabilitation of single-family properties, but it has to be that typically it's a 203K program. Takes a little longer to get the loan, 3 months, and you have to use, just a little caveat, FHA-approved contractors to make the repairs. You have to get those contractors to give you the estimates prior to closing on the loan. And then let's say that you're buying a $245,000 house. I forgot to ask him what the maximum FHA was. If I have to call him back, we'll ask him. If you're buying a $245,000 house that needs $65,000 in repairs, you can get a $300,000 mortgage. And then you can buy the house, and then as the repairs are done, the lender will cut the checks. You had a question?
I do. So there's a paragraph on 378 it says a qualified buyer may assume an existing FHA loan. So if you find a buyer, whether your seller has an FHA loan currently, you find a buyer that would qualify for FHA, it's saying it's cheaper to do it that way?
Yeah, because think about, yes, the FHA, you can have a buyer assume. There's two ways to assume. I don't know if we're gonna get into that in the slides. There's two ways to assume an FHA loan. One, what page are we on?
378.
One way is the FHA, for FHA loans originated after December 15th, 1989, the buyer must be completely qualified to assume an FHA loan. Investors may not assume loans made after December 14th, 1989. So FHA are assumable loans, but if the loan was made after 1989, the person would have to qualify for under the FHA and assume the loan, and you get taken off the hook. And that is a great tool. And the reason it is what are interest rates today? 4%? If rates go up to 8% and you have an FHA loan for 4%, the buyer can give you the difference in cash for the purchase price and the mortgage amount and assume your loan at 4%, where he can't get a 4% loan anywhere else. So FHAs are assumable. Conventionals are not. Okay. And I'm not going to get into the other ways to do it, but just know that FHAs are assumable. But the borrower, if it was after 89, I don't know how you can remember 89, don't even worry about it if you can't, would have to qualify and take the loan over. Okay. You can get an FHA loan on a condominium, but all properties must meet the FHA standards for type and construction and quality of the neighborhood. I don't know what quality of the neighborhood means. Prepayment privileges. You can repay a loan as long as proper notice is given 30 days in advance. So you can prepay an FHA loan and pay it off. Okay, assumption rules. Here you go. The FHA loans are assumable depending on the date the loan was originated, the type of property, and specific FHA loan programs under which the original loan was guaranteed. The lender of an FHA insured loan may charge discount points. Points. Here's that word Tony Soprano uses again, squirrel. Points. On a $100,000 loan, if you're paying 3 discount points, how much would that be? Do the math. Get your calculator out. Remembering, to give you a help for the ones that struggle with this, a discount point is 1% of the mortgage amount. Okay, 3 points. How much you gonna lend me, Tony? How much you need? 100 grand. I'm gonna charge you 3 points. If you watch The Sopranos. So how much would 3 points be on a $100,000 loan?
3,000.
3,000, 3%. And all points are prepaid interest. So if right now the interest rates with no points is 4%, you could probably get 3.5 if you paid 3 points up front. Up front, all points are upfront interest. Now there's also another fee the lenders could charge you, and they call it origination fee, a loan origination fee. How many points is a loan origination fee typically? 1%, 1 point. And that's for the cost of originating the loan. That's how a lender can make money. Remember we talked about that? Lenders can make money by servicing a loan, collecting the payments, paying the taxes and insurance, and by a loan origination fee. The loan origination fee doesn't affect the mortgage amount. It's just a fee, 1% of the mortgage amount. Discount points if you pay discount points, that will bring your rate down or lower your rate. So, you know, ain't nobody paying any discount points at 4% mortgages right now because the rates are so low. But when rates get up, when I was first in the business and rates were 12%, a lot of people wanted to pay discount points to get a better rate. They would pay discount points to buy the loan down to get a better rate. That's why they call it discount. You're getting a discount on the mortgage if you pay points. How much is a point, Lex? What percentage of the mortgage amount? 1%. You know it. You know this stuff. You know more than you think you know. Believe me, guys. You guys are just a little nervous because we're throwing so much craziness at you. Okay? So we talked about conventional, Samantha. Huh? What's the maximum loan to value ratio for a conventional loan? I could go for shot Clue right now. I sure wish I had some good students, Andrea, that would bring me in one of them little travel size. I don't want to.
There's someone over there.
Yeah, I have to buy that. What's the maximum loan to value of a conventional loan? How much?
80%.
80%. What are the qualifying ratios? The PIT ratios cannot exceed how much of the person's income? 28%. Just for a tidbit, FHA is like 36%. Could even be as high as 40. So with an FHA loan, not only do you need less money down, Lex, but you can make less money and still qualify for it. What's the maximum loan to value of a FHA loan? Conventional was 80%. FHA was 96.5. Because I asked for loan to value, not down payment. Okay. So let's talk about VA loans now. They're made by the Department of Veteran Affairs, and that's who guarantees those loans, okay, to purchase or construct homes for eligible veterans. So you have to be a veteran to get a VA loan. Loans are made by approved lenders. You have to be a VA approved lender. And these are high loan to value ratios, requiring little or no down payment. So, Jace, a VA buyer doesn't need any down payment. So a VA loan, Lex, would be 100% loan to value. Conventional was more stricter, right? But the house had to be, conventional was more loose as far as the down, needed a bigger down payment, but the house could be in a little bit more need of repair. FHA, you only need 3.5% down, but the house had to meet certain limits. VA, you don't need any money down, 100% loan to value. But again, the house is going to have to be in decent shape. And VA doesn't have a rehabilitation loan like who? Who has a rehabilitation loan? Conventional, FHA, or VA? Which one? FHA. That's the one Lex wants to get. She wants to buy an old farmhouse out in the country, FHA financing. She can go in with 3.5% down. She can buy something for $245,000, and if it needs repairs, she could finance. She said,
I want a farmhouse.
my little girl, she's a city girl. Okay. Financing terms for VA: maximum loan term of 30 years for 1 to 4 family dwellings, and 40 years for farms. Okay. The interest rate's negotiable, usually a little higher than FHA or VA, maybe not much higher than FHA, but definitely higher than conventional. Is if you can get a fixed rate or an adjustable rate, and it must be owner occupied. So FHA, they required owner occupied. You had to buy something and live in it, right? Bless you. VA has to be owner occupied. So if you want to buy an investment property, what kind of loan would you need? Conventional, FHA, or VA? Conventional. You can buy an investment property with a conventional loan. You can't with an FHA. It has to be owner occupied. VA has to be owner occupied. Okay? VA funding fees are paid at closing or included in the loan. Just like the upfront mortgage insurance for FHA is included in a loan, the VA will do the same thing. The fees vary depending on the amount of down payment, the type of property, and the eligibility status of the veteran. The VA funding fees vary on the amount of the down payment, type of property, and the eligibility. When we say type of property, we said it had to be 1 to 4, single family. Doesn't disclosure have something to do with 1 to 4 single family too? Huh? What does seller disclosure have to do with 1 to 4 unit single family homes?
You have to have the.
You have to have it. If you're buying a commercial property, do you have to have a seller disclosure statement? Does the seller have to sign and give to the buyer on a commercial property a seller disclosure statement?
Yeah.
What?
Yes.
No.
No.
The law says only 1 to 4 units.
Okay.
Because they feel that's protecting the average consumer who's buying. Just like FHA has to be a 1 to 4 unit. VA has to be 1 to 4 unit, or VA will include forms. Okay. Eligibility status can be determined by contacting the Department of Veteran Affairs. And if you're a veteran and you want to get a VA loan, and somebody comes to me and they say, hey, I'm a veteran, I want to get a VA loan. First thing I tell them is, do you have a certificate of eligibility? Proving to me that you are approved by the Veterans Administration. If they say, yeah, you're good to go. If they say no, I say contact the Veterans Administration, get a certificate of eligibility first. And the certificate of eligibility would determine their maximum loan amount. It's not a pre-approval. It just states that they can get a VA loan. Then a lender, and how much because of their service and so forth. Then the lender would do the pre-approval. I think, I could be wrong on that. The VA limits the amount of the guarantee. Fully eligible veterans need no down payment. So they did this, I think, at the end of World War I. I don't know when World War I was over. Maybe even World War II. I think they did this after World War II. We had all these veterans that were fighting. When they came back, they had the VA loan program, which gave these people, the veterans, an opportunity to buy houses or build houses. With VA, you don't get an appraisal. You get what they call a certificate of reasonable value. So I would know that. It states the current market condition of the property based on a VA-approved appraisal. So it's like the same thing as an appraisal, except the VA calls it a certificate of reasonable value. And that value, whatever the certificate of reasonable value or / appraisal would be, that would limit the amount the VA buyer is permitted with no down payment to purchase. So if the VA comes in and does their appraisal, which is called a certificate of reasonable value, and on this house here, the purchase price was $145, and they came in and said the certificate of reasonable value is $140, the veteran can't buy it 100% financing unless he came up with a difference in cash. Now with FHA financing, same concept. If he was buying this FHA and his mortgage amount was $236, $245,000 house, if the house doesn't appraise FHA, then the borrower would either have to come up with more cash or the sale price would have to be adjusted down. Conventional, same thing.
Could he get another loan for the difference?
I don't know if you're allowed to do that right now, get a second loan for the difference. When we're talking about financing, we're going to talk about being able to do that. So you can do it. I don't know if anybody offers it anymore.
Gotcha. No problem.
So if the purchase price is greater than the certificate of reasonable value, the veteran must pay the difference. Prepayment privileges, the borrower may prepay the debt at any time without penalty. As a matter of fact, just a little side note, if you're buying a residential house, you can pay the loan off at any time without a prepayment penalty. Commercial, when I got a commercial loan on my office and I wanted to pay it off, there was a prepayment penalty, okay, with commercial loans. And I was paying it, I was just refinancing it. I found a better rate. Now, as far as the bank's concerned, they're paying it off if you refinance, right? Assumption rules for VA. Remember we said VA loans are assumable, FHA loans are assumable? That if you had an FHA loan, somebody can assume it if they qualified for it and you wouldn't be obligated. You could sell the property to them. Can you do that on conventional? Can you assume a conventional loan? No. But you can assume a VA loan, okay? And the procedure varies depending on the date the loan was originated. Okay, it varies depending on the date the loan was originated. Because they changed the guidelines. For FHA, they changed them back in the 90s. They changed the guidelines. Because when I first got into business, there was two ways to assume an FHA loan. You could just have somebody come in and take over the payments. You were personally responsible, but they can assume your loan. They quit that out in the 90s, and now you have to qualify under the same guidelines, the FHA. And now that you assume an FHA loan, you're out of the picture. Back then, when I first got into business, somebody can assume an FHA loan, make the payments to the lender, and they could have bad credit. You didn't care. But if that guy quit making the payments, you were responsible. They changed that in the 90s. We're not going to do that anymore. Now, if you want somebody to assume your FHA loan, yeah, they got to qualify under the same guidelines you do. With VA, they're assumable also. But in the assumption, and it depends on the year, and I would assume the VA kind of did the same thing. The VA funding fee may be required. If somebody wants to assume a VA loan, they may have to pay another funding fee. The original borrower remains personally liable to the VA unless the VA approves and releases the liability. So when I used to sell a lot of foreclosures when I got started in the business, we sold a lot of FHA VA that were assumable. And the investor could come in and assume the VA loan or an FHA loan. So the original borrower remains liable for the VA unless the VA approves and releases the liability. The assuming borrowers who are veterans can use their entitlement. So they can use their certificate of reasonable, not certificate of reasonable value. What's the entitlement called? Eligibility. Okay, any questions on VA or FHA or conventional? Those are the three main ones. Okay, but there's another one. Oh, who buys VA loans? Who can the lender sell their VA loan to? Who? Jenny Mae? No, Fannie Mae. Fannie Mae. I think Jenny Mae too. I think Jenny Mae will buy VA loans too. Now we have agricultural loans. I know. You're tired. There's a lot of questions on a test on this stuff, so that's why I'm kind of taking my time with this unit, not burning through it. Farm Service Agency. The Farm Service Agency guarantees loans for the purchase or improvements of single-family homes in rural areas, or for the operation of a family farm. They call it the Farmers Home Loan Administration, has been moved to the Department of Agriculture. So anybody from the West Newton area know of a plan up there called Collingate Manor? Who said yes?
Yeah.
You do, Tam? A lot of those homes were farmer home loans, where people with low income could get a brand new house. And some of those houses are real small, aren't they? They're like small little splits, 1-car garage, 3 bedrooms, maybe 1 bath, unfinished game room, but they could get a brand new home for like 80 grand at the time. So a lot of those were sold and financed through the Farmers Home Loan Program. Then there's a farm credit system, bless you, provides loans to farmers in rural areas, and Farmer Mac is the government-sponsored entity, bless you, similar to Fannie Mae and Freddie Mac. And pools of loans are bundled and sold as mortgage-backed securities. Whew. We needed a minute, bless you. Do you guys have a pretty good concept of the difference between somebody who wants to get a conventional loan, an FHA loan, or a VA loan, or even now a farm loan through the agricultural program, Farmer Mac, or the agricultural loan program? Okay. Let's take a 5-minute break, because before I get into this next section, because I don't want to throw anybody over the edge, but today's Thursday. Sarah, what I would do tonight is don't read ahead tonight or tomorrow. Okay? Go back over this unit. Okay?
I'm still running this, right?
What's that?
I'm still running this, right? It's still the same.
We're still running it. We're going to take a 5-minute break for you guys on YouTube. And then we're going to get back to it, because we can't stop it and start it. Or can we? Why don't we do this? Why don't we stop it right here?
Okay.
And we'll do on financing techniques. Let me see how many pages we got. Yeah, and we'll do just a short video on financing techniques.
Looks like a church.